Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Ty. How are you?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about bonds. It's part of a portfolio that most people don't really talk about a lot because they're not real exciting. And I also believe there are a lot of misperceptions about bonds. We hear from a lot of people that they have bonds in their portfolio because their investment advisor told them they're safe. Okay, so we need to talk about that. Find out really, are they safe? You got to be careful when you use that word. I think they're conservative, but also you can take risk also when you have bonds in the portfolio. Bonds aren't intended for everybody, and I think they're misused many times, especially when we start talking about tax-exempt bonds like municipal bonds. Unfortunately, Tyler and I see a lot of people come in with statements and they're carrying municipal bonds, but they're not in a high tax bracket. So what does tax relief really do for you when you get a low rate of return and you don't benefit from the tax-free municipal bonds? So we'll talk about things. But basically, the first thing is, what is a bond? People talk about stocks and bonds all the time, and when they talk about stock, they talk about mutual funds and exchange-traded funds. But when they talk about bonds, they don't realize that bonds can be purchased as a whole entity. It can be a bond itself, or you can buy bonds within mutual funds, a mutual fund bond, or an exchange-traded fund bond. But there's also different types of bonds depending on what you want to achieve with them. Do you want to get income as you grow older and into retirement? Eventually, your portfolio needs to create income for you so you can spin that off and go into your checking account each and every month and pay the bills and travel and buy what you want. So, we need to look at things and see, does a bond portfolio or a portion of it give you some of that safety or a cushion to volatility, or does it give you income? But understand, stock positions are really, you're buying shares of a company. You're a stakeholder. You are owning a portion of that company. Most of the time, it's a non-voting position in that company. If it's common stock, preferred stock are viewed a little bit differently. But then when you look at bonds is really a debt that you're buying. You are contributing to the bottom line of a company by paying off some of their debt. And in return for helping them pay off some of that debt, you get interest many times in the form of the yield on the bonds. So, Tyler, as far as the bonds are concerned, there are a lot of different types of bonds. Let's go through some of those bonds, and we'll talk about the most conservative ones first, especially for those people who right now the market is getting pretty high, and we hear a lot of people say that they want to move into a little bit more conservative positions. Do understand that conservative doesn't always mean safe. Okay, please understand that. But again, where people make a mistake is they just tend to think that a bond position, all of them are created equal, and they really aren't. But let's talk about the type of bonds first.
Yeah, and Dean, even before we get into that, again, like you had mentioned, I think it's important that people know that bonds are considered a debt security where the issuer owes the holders a debt and they're obligated to pay them interest and principal at a later date. So it's kind of like where if someone were to go to a bank for a mortgage loan, for example, and the bank would then give them the money, however, they have to repay that back along with interest. A bond is kind of the same thing, where it's really debt that you're buying, except you get your money back at a later date and interest payments all throughout until your money is back. So you're investing in something and getting interest out of it and your principal back at the later date. But jumping right in, when we talk about bonds, there's a number of different bonds. And depending on which one is right for you depends on a number of different things. And the first thing that it really depends on would be your tax bracket. We're going to get into that as we go along here. But that's kind of the first thing that determines how to sort it out, whether it's municipal bonds or other bonds. But as we get into the first choices here, the first ones that we want to touch on are going to be treasury bonds. And Treasury bonds, now they're issued by the federal government to finance its budget deficit. So right now those are known as government bonds, treasuries. So they're backed by the United States government and their taxing authority. They're considered credit risk free. So treasuries are often very conservative, again, backed by the U.S. government. But with that, their yields are always going to be the lowest. So that's why with treasury bonds, okay, you can get very conservative, but yet at the same time, the yields are very low.
Okay, Tyler, I just want to throw something else in there about treasuries that I just thought of. When we came out of the Great Recession of 2008, 2009, the government went through a process called quantitative easing. And what they did is they created bonds that were being sold to help support the market. And that's where you saw treasuries being sold, really. And that's where people really started to understand what treasuries were. And as Tyler said, they're very conservative. And many times people will use those in a portfolio where they're carrying significant cash for a couple of reasons. They're carrying the cash because they, A, don't feel comfortable with the position in the market, or B, they want to carry cash to be able to buy low when they get into a market trough, which is part of that risk managed portfolios that we do. Some people want a better rate of return, so what they'll do is buy treasuries because, as Tyler said, they are guaranteed by the U.S. government, but they will pay you better interest rate than cash positions, but not by much.
Yeah, good point there, Dean. So the first one, and we do have some clients who they look for treasury bonds and treasury bond funds. Again, something that's very conservative, but yet again, you have to know that, okay, if it's going to be very conservative, you're not going to get a whole lot of return. The interest rate isn't going to be very much. So treasury bonds backed by the U.S. government, they are quite conservative, but at the same time, you're not going to get that much yield out of them either. So you're not going to get a high interest rate out of those. But then in addition to treasury bonds, there are also other U.S. government bonds backed by different federal agencies, a lot of them being different mortgage associations, and those are called agency bonds. So people hear of Fannie Mae, which is the Federal National Mortgage Association, and Ginnie Mae, the Government National Mortgage Association. And then in addition to that, Freddie Mac, the Federal Home Loan Mortgage Corporation. So those are all different types of federal housing agencies. Those are other government-issued bonds. Now they're called agency bonds, and the interest rate that they pay, those are higher than treasury yields because they're not the full faith and credit of the U.S. government. But the credit risk is considered minimal. So the agency bonds, they will give you typically they'll give you a little bit higher interest rate than treasury bonds, but with that comes a little bit more additional risk because again, those agencies are not backed by the full faith and credit of the U.S. government. So that's where we go one step up the line where you could potentially get a little bit higher rate. But then again, always remember that if you're going to get a little bit higher rate, the risk also is increased as well.
Okay. Another thing is, investment grade corporate bonds. This is one that we tend to see and focus in on many times. Again, it's going to give you typically better interest, better yield than some of the treasuries or government-backed mortgage bonds. So investment grade corporate bonds. However, again, you don't just want to go in and accept the fact that your investment advisor is putting you into a bond account. Ask what type of bond account it is. Investment grade corporate bonds, many times the companies that see their stock rising so significantly over the last couple of years also create bonds. So you can go in and check to see the financial stability or instability of the company before you want to go in and start to buy some of these investment grade corporate bonds. We're seeing more and more people use those in portfolios than we have in the past.
Yeah, Dean, these ones are one of the most common ones that we see, probably more so than even a lot of agency bonds, but investment grade corporate bonds. So these are issued by public companies, and typically the companies that issue the investment grade bonds, they have strong balance sheets, they're strong financially, and in order for it to be an investment grade bond, there's a rating scale for bonds, and they have to carry ratings of at least a triple B or higher. So then it goes all the way up to AAA as the highest. So they have to be rated. The company that issues the bonds has to be rated very, very well financially. And for investment grade bonds, usually the risk of default is considered pretty minimal. However, it can happen. It has happened. So just know that, again, a pretty big misconception with a lot of people. They think that just because you have bonds, it means you're safe and you can't lose money. But that's a big misconception, because you can lose. They're considered more conservative than stocks in the stock market, but you can lose with bonds. So with investment grade bonds, their yields are typically going to be higher than treasury bonds or agency bonds, and they are fully taxable as well. Now, in different types of economic downturns, such as 2008, these bonds tend to underperform treasuries and agency bonds just because these are bonds of individual companies, and companies can be hurt. Individual companies can be hurt more than the overall U.S. government. So these bonds are going to give, investment grade bonds, they will give you a higher interest rate than treasuries or agency bonds. However, they do carry more risk. So we're going up the scale on risk a little bit as we go on here.
Okay, what we'll talk about next, since Tyler said we're going up the risk scale here a little bit, is high yield bonds. Now, people hear the term high yield bonds. You're familiar with that. People also hear the term junk bonds, and it's really the same thing. And, just think about it once. If you're going to receive high yield, as the name says, you're going to take more risk. Just like stock, if you're looking for a stock that gives you potential for significant out of the ordinary growth, you're going to take significantly more risk and have to speculate a bit. Well, same thing with bonds. If you're looking for a high yield meaning money, interest that's going to be coming into the account, you have to be prepared that you're going to possibly take on junk status. And what that means is, they typically carry a rating below a triple B when you look at Moody's or some of the other grading services that follow bonds. And there is also a possibility of default from these companies. So again, understand when advisory firms are putting bonds into your portfolios, or you're considering buying bonds, the yield from high yield bonds does look more favorable. Understand, though, with that comes more risk.
Yeah, Dean. So again, with the main thing to take away with high yield bonds is, as the name implies, they can give you a higher yield, meaning you can get a higher interest rate if you were to invest in high yield bonds. However, they do carry a distinct possibility of defaulting. So how I usually view high yield bonds is, if you think about it, they're someone who might not have very good credit. They might not be considered a good borrower if they were to go to a bank or credit union and want to get either a mortgage or a car loan or whatever it might be. And therefore, if they want to go and if they want to borrow money, their interest rate is going to be higher. So it's the same way, except it's high yield bonds are companies that are the ones who are being funded that way. So companies that might not be as strong, they might have relatively weak balance sheets, and just overall financially, they might not be as sound as some other companies. They will pay you a higher yield, but in order to receive that higher yield, you have to be okay with the possibility of that bond defaulting and that company defaulting. So when we talk about high yield bonds, typically high yield bonds, they might follow the performance of stocks more than they do investment grade bonds. So be careful if you're in a portfolio and you have a certain percentage in stocks and stock funds and then a certain percentage in bonds and bond funds. And if you look and the bonds that you're in are all high yield bonds, then that's not going to offer you much stability and protection as it would investment grade bonds, treasuries, agency bonds. So always want to make sure that you know what kind of bonds you're in. And again, high yield bonds, they're correlated more closely to stocks than they are bonds. So keep that in mind. But last thing with high yield bonds, just remember that you can get a higher interest rate, but they do carry substantially more risk than other bonds.
Okay, the next one we're going to talk about are foreign bonds. And again, we're going up the scale here with risk. When it comes to foreign bonds, just as the term says, I mean, they're from foreign companies. So remember, they are regulated to the point where they're allowed to sell the bonds here in the United States. But again, it's a foreign company, and that always gives me a bit of a pause. So you are going to be taking more risk if you're going to be buying bonds from foreign companies. Also, with that comes currency risk. Many times, the denomination of the bonds comes with the currency from the country that it's originating, and many times the exchange rates, more than interest rates, can determine how a foreign bond fund performs. So understand that. And again, I keep on going back to this. I said 2 or 3 times. Understand what type of bonds are being kept in your portfolio. Don't just accept the fact that you have 40% or 20% or 60% of your portfolio in bonds. What type of bonds? Some bonds perform better than others based on certain times of the business cycle, or whether we have a significant trade deal done with some foreign countries versus a trade war. So understand those things. Foreign bonds, you are going to be taking on risk of currency risk, and again, exchange rates more than interest rates determine the performance.
Yeah, Dean. So with that, foreign bonds go hand in hand with high yield bonds when we talk about the top of the risk scale when we're talking about bonds. So high yield bonds and foreign bonds are about as risky as you can get when it comes to bonds. And again, foreign bonds, they are dollar denominated, but the average foreign bond has about a third of its assets in foreign currency denominated debt. So keep that in mind. If you're buying foreign bonds, there's definitely risk that comes with that. As you mentioned, Dean, a lot of that is the exchange rates more than interest rates can determine how a foreign bond performs. But foreign bonds are something that you have to be very in tune with to invest in. Just because you have to know the countries that the bonds are investing in, you have to know all about their currency, the exchange rates. It's very complex if you were to invest in those. So again, high yield bonds and foreign bonds, you can get potentially good interest rates and higher yields out of those. However, with the higher rate of return, the higher interest rates, comes more risk. So just recognize that when you're investing in any type of foreign bond or high yield bond.
Okay, before we continue, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions, located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, the last bond that we're going to be talking about is municipal bond, and we're not necessarily going up the risk scale here. It just sort of stands out on its own. A lot of people have heard about municipal bonds, or they call them muni bonds, and the real hook here for most people when they're interested in municipal bonds is the fact that you have the ability to get federal tax-free income from them. So, however, it also creates some issues that we see too. As I said earlier in the show, Tyler and I will see statements from people that come into our office and want us to give them a complimentary review, and they'll be carrying a significant number of municipal bonds. And we'll ask, what is the reason for that? We don't know if they're risk averse. We don't know if they're looking for significant income because they need it from the portfolio, or they're in a high tax bracket, so they need some tax relief. And many times we will see people who are actually not in a high tax bracket. Sometimes we see people who don't even have to pay taxes because their income is so low, and they have municipal bonds, which really defeats the purpose. And part of the reason is municipal bonds, the yield is typically very low because in addition to the yield or the interest, you also have some tax relief. So you have to throw that in there. So typically the municipal bonds spin off a lower interest rate or yield, but again, it can be federal tax free. Also, if you buy municipal bonds in the municipality where you live, there's a possibility you can have state tax-free income out of there too. So there's a possibility of state and federal tax-free. Municipal bonds should be scrutinized before they go into your portfolio. You should have an advisor who looks at your tax situation with a tax advisor. Tyler, anything else on the municipal bonds?
Yeah, Dean, kind of just to reiterate what you said, when it comes to municipal bonds, the number one thing that you want to look at is, first off, what your tax situation is like. So if you're in a higher tax bracket, then municipal bonds will probably benefit you a lot more than a lot of the other bonds that are taxable within a brokerage account. So again, if you're higher tax bracket, municipal bonds are going to be the way to go. However, if your tax bracket isn't very high, then it doesn't really make sense, because the yields on municipal bonds are lower. So it doesn't make sense if you're in a low tax bracket to get municipal bonds when you could pay taxes and yet still come out ahead investing in different corporate or investment grade bonds. So number one thing to look at is your tax bracket. But then in addition to the tax bracket, municipal bonds both come in the investment grade type and the high yield type. So that's where you need to take a look too at the different state and local government that you're investing in. So just because it's a municipal bond doesn't mean at all that it could be conservative or safe. Now, some are very conservative and some are very sound depending on the municipality or the state that you're investing in. Others might not be. So that's where you have to look at the state that you buy your municipal bond in and determine how sound that is financially, how sound that project is that the bond is funding financially, and you really want to evaluate that. But so the interest with municipal bonds is federal tax-free, and it can be state tax-free as well, depending on the bond. So that's something that you want to look at too. We've had people that they think they're investing in municipal bonds that are both federally and state tax exempt, come to find out that they're only federally tax exempt and they have to pay state taxes on them. So you also want to dive into that too before you were to invest in municipal bonds. But the number one thing when it comes to municipal bonds is just look at your tax situation before investing in municipal bonds. If you are in a higher tax bracket, they're probably the way to go. If you're not, then you might be better off with different investment grade corporate bonds or treasury bonds, or maybe even throwing a few high yield bonds in there. So again, with municipal bonds, always depends on what your tax bracket is.
Okay, now we're going to talk about who should have bonds in their portfolio. Okay, this is something, again, when Tyler and I sit down for a review and we look at statements from people coming in the door here, many times we'll see people in their 20s and 30s and sometimes even into their 40s, and with their 401k statements, many times they will hold bond positions or some fixed income or money market positions, and we'll ask why. And they'll say, well, if the market goes down, it gives me some protection. Well, again, when you're in your 20s or 30s and you have a significant time period, before you retire, are you really well served by carrying those bond positions at this time of your life? You're probably better off if you're a bit risk averse, or you would like to have not quite the bounce that some of the more small cap or mid cap or large cap growth would give you. You might look at S&P or Dow value options that they give you in your 401ks, but we just don't see a lot of reason for carrying bonds in your portfolios when you're trying to generate wealth early on in your life, in your 20s, 30s, and even in your 40s. And then again, as we get older, many people look at target date funds, and they're very popular in 401ks, and they're very popular with a lot of investment advisors outside of 401ks. And what they basically do is it's target date. So if you pick 2020 as your target date, what that means is if you anticipate retiring in the year 2020, how is the portfolio going to look? It's going to be very conservative from a standpoint. Your fixed income and your bond positions are going to be very high. It could be 60, 70, or 80% at that time. If you decide as an employee that you're going to pick 2040 as your target date, you're going to be significantly more invested in the stock equity positions and very little bond positions. So I guess where we're going here to split hairs, do you need bonds at all? That's something that you need to talk to your investment advisor if you are in your 20s, 30s, and even in your 40s.
Yeah, Dean, good point there. But yeah, when we talk about different retirement accounts and we see people that come in and they have a Roth IRA or even their 401k and they're in their 20s, 30s, or 40s, well, that's considered, a retirement account is considered a long-term investment. So with many retirement accounts, you can't even access it until you're at least 59 and a half years old. So you have such a long time frame that usually with bonds, if you have bonds in your 401k or your retirement account and you're younger, they aren't going to give you the rate of return that stocks will. So you might be doing yourself a disservice by having any bonds in there over the long term when you're younger. But then for many people, as you get closer and closer to retirement, they do act as a form of stability and protection against catastrophic market downturns, where if you have a layer of bonds in there, you won't feel the blow of a major market downturn as much as holding only stocks. So that's where, when you get a little bit older, and instead of you continuing to contribute to your 401k and putting all this money into it throughout your working years, when you retire, you do the opposite and you start taking money out. Well, then you're probably not going to be going to be able to tolerate that risk as much. So then having some bonds in there to kind of cushion the blow of a big market downturn, we find that really does help for many of our retired clients when they're taking money out, because it acts as a hedge against the stock market when it's going down. Now, bonds, they can go down as well, but we don't see anywhere near the losses in bonds that we do stocks when the market's going down. So bonds, what we find again is that when people are younger, usually within a retirement account, usually there's not a whole lot of use for bonds. But then as you get older and closer to retirement, and then in retirement, then bonds become much more useful, where they can act as a little bit of protection and stability when you have any type of big market downturn.
Okay, the last thing we're going to talk about is, you hear a lot of people talk about the price of a bond and its yield. Okay, and do understand that many times is an inverse relationship. So what happens is, people are excited for the fact that the bond price is going up in their portfolio, but unfortunately the yield percentage or the interest gained is going down. Again, on the flip side, when the bond price goes down, the yield comes up. So you need to take that into consideration. Many times people would look at, extremely high yielding bonds. Again, in a situation like that, you're going to take more risk. That's usually in the form of junk bonds or high yield bonds. So Tyler, anything else when we talk about the yield versus the bond price?
Yeah, Dean, the last thing with bonds is just, and it's very important to note that bonds are very interest rate sensitive, meaning if interest rates go up, your bond price is going to go down. And if interest rates go down, your bond price is going to go up. So they always have an inverse relationship with interest rates. And over time, the interest rate that your bond pays will fluctuate based on the overall interest rates going on in the economy that the Federal Reserve sets. So just know that if interest rates go down, your bond price will go up. And if interest rates go up, your bond price will go down. But then the interest rate that your bond pays will always be based on interest rates either going up or down. So again, a big thing to note, just interest rates will definitely affect the interest that you're getting on your bonds.
Okay, that's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.